Good evening, everyone, and thanks for zooming in tonight. I am a CFP, and I also have an MBA from the Wharton School of Business. Tonight, we're going to review some strategies for investment planning, retirement planning, and risk management tailored for physicians and in certain market conditions. I'm going to do the presentation first, and then at the end, I can have a Q&A for anyone that has questions that arise. And with that, let's get to the presentation. Okay, so tonight we're going to discuss investment planning and risk management strategies you could take to safeguard the future of your practice and your family. I'll also just talk briefly about the impact that some of the new retirement legislation recently passed will have on your investment and retirement planning strategies. These topics are particularly relevant as because of all the increased challenges that have been caused from the COVID pandemic, this has been a very stressful period to be a physician. I know of a doctor who recently retired early because of his frustration with managed care. Now let's talk about how to safeguard your financial future. When you end the workday with your patients, focusing on personal finance issues and topics likely might not seem like a priority when you're in that moment. Surveys and focus groups conducted have uncovered challenges that many medical professionals face when it comes to planning for retirement. For example, approximately 60% of those surveyed say that they don't have time to focus on securing their own retirement because of other time-consuming problems. Just 6% have indicated they feel knowledgeable about investing. So as many of you know, the Federal Reserve recently hiked the benchmark Fed funds interest rate to the 5% range, which is the highest level since 2008, as inflation has been running at a 40-year high. And the stock market has reacted accordingly, and it definitely had some large declines last year. In 2022, the classic 60% stock and 40% bond portfolio had its worst performance in the last century. So valuations fell below their 25-year average, but this has definitely created some opportunities because in general, as stocks and bonds fall, the future expected returns increase. So one of the best ways to avoid mistakes and make sure you're making investments that are well suited for your needs, especially in uncertain market conditions, is to put a plan in writing with the correct updated assumptions. It's important to test your plan using a wide range of assumptions and customize it to your unique circumstances and factors. In the words of the great philosopher, financial advisor, and the former Yankees catcher Yogi Berra, you've got to be very careful if you don't know where you're going, you might not get there. So the first step in creating a personal financial plan is to evaluate your financial situation. Next, the discovery and information gathering process allows for the development of recommendations and alternatives. And finally, the plan and action steps needs to be implemented and when necessary, monitored. So making a plan allows a decision-making process for investment strategy, taxes, estate planning, and retirement age selection. And very importantly, a formal plan can bring to light flaws that you might have in your investments and in your retirement plan, while there's still time to take action and help prioritize what's most important. Just the other day, I took my two kids out for ice cream, and by the time they added self-served themselves and added extra toppings, bill came to over $20. So expenses aren't always what we expect them to be. And so a plan is sort of built to help adjust for those things and put those things in light. A plan can also provide peace of mind and prevent market fluctuations from causing panic. Interestingly, in 2022, the average market prediction from analysts on Wall Street had a 30% deviation from what had actually occurred. This is a flat I really like. I think it's very important for consumers to be aware that there are many different types of investment advisors that are out there. And there's many conflicts of interest that exist in the financial advisory world today. So there's three broad types of classifications used for financial professionals. The first is a fiduciary, or an investment advisor representative of a registered investment advisory firm. And according to the Securities and Exchange Commission, this category represents approximately 12% of advisors today. The second type of advisor is a non-fiduciary, or a registered representative of a broker-dealer. And according to this category represents approximately 27% of advisors today. And the last category is a hybrid or a combination of one and two. And according to the Securities and Exchange Commission, this category represents approximately 61% of advisors today. So advisors who possess a fiduciary duty to their clients are required to put their clients' best interests above their own at all times. Many people are surprised to find out that this obligation isn't required of all advisors. In fact, most advisors aren't required to act as a fiduciary in all their interactions with a client. Advisors who are not fiduciaries often follow a suitability standard, but this only requires that they give their clients advice which is deemed suitable for their situation, and it offers fewer protections and safeguards for clients. A fiduciary advisor is important if you plan to give an advisor discretionary control of your account, if you aren't sure exactly what sort of advice or services you need, and if you want sound, objective advice. When seeking wealth planning strategies, it's important to bear in mind that not every firm providing financial advice is a fiduciary advisor. So the basic concept around the term fiduciary is that this type of advisor only can receive compensation directly from the client for services provided. So in other words, fee-only advisors don't receive sales-related compensation from their employer or third parties like fund companies, and they don't receive commissions. So in this instance, fees could take the form of a flat rate or an hourly fee, a subscription fee, or an investment management fee. Fee-only advisors can work with clients on a one-time basis or an ongoing basis. Now, non-fiduciaries are typically compensated through commissions on securities transactions, but they might also charge fees to access some parts of their platforms. So it's important to be aware that advisors with a Series 63 or a 66 license are allowed to collect commissions on the sale of investment products. And these fees might often not be clearly disclosed and transparent to the client. So you really have to know what to look for. A hybrid structure normally has representatives who are registered both with a broker-dealer and an investment advisor. So this means this type of advisor has a fiduciary side and a non-fiduciary side. And this approach can be confusing for clients who must determine if they're being given fiduciary advice or if they're being sold a specific product. Everyone's needs and desires are different, and there could be good and bad in any model, but it's very important to know what type of advisor you're working with, and that's going to help you understand what questions you need to ask to protect yourself and understand the situation. You should evaluate your advisor on their experience, educational, professional certifications, their engagement with you, as well as their areas of expertise. I'll also add that there are many well-regarded regional and national brand name storefronts that don't follow fiduciary standards, and this may be in direct conflict with what is in the best interest of prospective clients. In terms of setting and prioritizing goals, you want to prioritize your goals and then customize a plan which will maximize your potential to achieve those goals. Amelia Earhart once commented that preparation is rightly 2/3 of any venture. And it's important to test your plan using a wide range of assumptions and then customize it to the unique circumstances, factors, and goals that you're trying to achieve. These are all some tax-related strategies that I'm going to go through briefly in the next few minutes, and they can all be used at any point during the year. Regularly contributing to retirement accounts is an important component of investment planning. Whether you're self-employed or work for a private organization, there are different types of retirement plans you can start taking advantage of to prepare for your post-career life. If possible, you should maximize contributions to retirement accounts, and there's plenty to choose from, as many of you know. A good general rule is to contribute 10 to 15% of your income, and this includes any employer matching contribution. Retirement accounts are really critical because they combine the power of compounding with the benefit of tax-deferred and, in some cases, tax-free growth. For example, if your marginal federal tax bracket is 35% and your state bracket is 5%, after taxes, saving $1 only costs you 60 cents. And so compounding isn't a concept you want to miss out on. And missing out on tax advantage investment gains can be a very expensive proposition when it comes to your retirement. Depending on your employment status, there's multiple ways to save for retirement, and here's some options. If your income is earned from an employer, then 401k plans and 403b plans are some of the many options to choose from. And the correct choice will depend on your personal circumstances. For physicians that own your own practice, you'll need to devise your own plans for saving for retirement. And this might involve establishing your own 401k plan for employees. If your income is earned from self-employment, then a solo 401k or SEP IRA are some typical options to consider. But you definitely want to beware, and I'll discuss shortly a very common pitfall for some small business owners with respect to retirement planning and SEP IRAs. If your employer plan allows after-tax contributions, you can save up to a total of $66,000 in 2023, $73,500, including catch-up contributions if you're 50 and over. And the $66,000 includes all contributions, including your employers. So this is a graph I'd like to show. And in simple terms, compounding means that the interest and investment returns you receive over time is reinvested. So you can earn interest and profit on profits. And this multiplies your money at an accelerated rate. So in this instance, it just shows the difference between starting contributing at age 25, 35, and 45. Now, obviously, many of you are well past 25, but the point that it's trying to demonstrate is if you contribute $500 a month at a 7% return, you can see the very significant difference once this individual hits 65. And so this is so for the, throughout the course of your planning horizon. So the compounding and the ability to take advantage of that compounding in those early on years, which is the main point, really, really has a very large impact when you look down the road. And that's the point that shouldn't be missed. So equally as important to contributing to retirement accounts and other types of accounts is the order or sequence in which you invest in these accounts. The sequence you invest money at may have implications as to whether or not you're able to take advantage of tax deductions in the current year, and also whether you're able to pay less at tax time in the future when you make withdrawals. So you want to max out your 401k or IRA or solo 401k each year, then a backdoor Roth, and then your individual or joint taxable accounts. Here's a little diagram depicting the sequence I just described. Now, at the end of 2022, on December 29th, the Secure Act 2.0 was signed into law. And this contains many provisions that impact retirees and investors and creates significant financial planning opportunities to take advantage of. So here's a quick summary of some of the key points. It's definitely not all of the points. The age to start taking required minimum distributions increases to age 73 in 2023 and 75 in 2033. There's larger catch-up contribution options available now for those nearing retirement. So that's a big opportunity to catch up if you are in that position where you want to. Provisions also make it easier for employers to offer a match to their retirement plans for payments to employees. And that could be a good employee retention benefit. There's also improved access to emergency savings, and required minimum distributions on Roth 401ks are now going to be removed in 2024, which is a big planning opportunity. And then also for those that have used 529 plans for their children's education, there's going to be penalty-free rollovers with some restrictions, and I'm going to get into that further. But that's a planning opportunity that didn't exist before, a great way to avoid penalties that nobody really wants to take. So a solo plan is just a traditional 401k plan covering a business owner with no employees or the business owner and his or her spouse. So anyone who generates net profits from a sole proprietorship, an LLC, or other business organization can open a solo 401k as long as they have no employees aside from their spouse. So solo 401k plans offer self-employed and owner-only businesses high savings limits and tax advantages. Solo 401ks allow you to contribute to the plan as both the employer and employee, providing you the ability to maximize your personal retirement contributions and business deductions while lowering your personal taxes. But hiring just one employee for your business in the future beyond your spouse would eliminate the solo 401k as an option. So if you plan to hire employees in the near term, this plan might not be for you. There's a lot of detailed requirements and rules that govern this plan also. So a SEP IRA plan is an IRA for the self-employed and small businesses. But unlike the IRA you might know about, this one has much higher contribution limits. And in 2023, you can contribute up to 25% of your compensation or $66,000, whichever one is greater. So a Roth IRA is an individual retirement account that offers tax-free growth and tax-free withdrawals in retirement. It doesn't matter if you're covered by an employer's retirement plan, such as a 401k or 403b. As long as you don't exceed the IRS's income limits, you can still contribute the maximum amount to a Roth IRA. For 2023's tax year, that's $6,500 or $7,500 if you're age 50 or older. Now, these plans aren't offered through employers, but they can be set up fairly easily. And whether or not you can make contributions to this plan depends on your tax filing status and your modified adjusted gross income. Now, high-income medical professionals often do not qualify to make Roth contributions, but you can make backdoor Roth IRA contributions. Backdoor Roth IRAs allow you to make non-deductible traditional IRA contributions and then immediately convert them to a Roth IRA. And that's why they're called backdoor Roth IRAs, because your entry point is not through the normal front door. This is a little loophole in the tax code in some respects, and it can be a big advantage to retirement planning. And also, this is why, for someone who's self-employed, a solo 401k plan might be better than a SEP IRA, because in the instance of a SEP IRA, when you do the backdoor Roth conversion, you trigger some taxes in your SEP IRA plan, but you're not triggering some related taxes in your solo 401k. So there is a pretty important advantage if you're setting up and you have the option to choose between that solo 401k and the SEP IRA. So if you have an existing IRA, completing those backdoor Roth IRAs each year, it can be done, but it's going to become logistically complex based on the tax code. I think that's something you really want to make sure you're aware of. Most people tend to miss that in their retirement planning. Spousal IRAs are another type of account you should consider. The spousal IRA permits a spouse who doesn't work or earn income to fund an individual retirement account. It's important to understand the rules and how income thresholds affect tax deductions. The IRS rules are definitely complex, and what you do depends on a variety of factors. You can use dependent care accounts and establish a 529 education savings account. You can use a 529 plan to pay for college, kindergarten to 12th grade tuition, apprenticeship programs, and student loan repayments. My wife and I funded these for both our children, and it's definitely worked out very nicely. As you can see here, the kids are very happy. The new retirement legislation that I was talking about a little earlier, or Secure 2.0, also has an impact on these education savings accounts, these 529 plans. And I think that's very important to be aware of. So families can make a tax-free rollover from 529 plans to Roth individual retirement accounts starting in 2024. Now, these transfers do come with some restrictions. There's a $35,000 lifetime cap on transfers to a Roth IRA. A lot of people might have excess funds in their 529 plans, and so that's a big saving opportunity right there. After 15 years, the rollover can only be made to the beneficiary's Roth IRA, not the account owners. Now, rollovers are still subject to the annual Roth IRA contribution limit, and they will be counted against ordinary contributions, but you can avoid some nice penalties there. So that's something to be aware of. So you should always, another type of account I wanted to mention quickly that you want to consider is a custodial account. And these accounts can allow parents and or grandparents to start investing for a child today. These accounts are tax-free or taxed at a low kitty tax rate for the first $2,500 of earnings in 2023. You should always contribute to accounts to manage medical expenses, such as HSAs, health savings accounts, or FSAs, flex spending accounts. Based on your areas of expertise, you're likely very familiar with these types of accounts and how they can interact with health plans. Health savings accounts offer a triple tax benefit, making them one of the tax code's most tax-favored savings vehicles. One important point to emphasize is to get the optimal benefit from a health savings account, you should invest the money and avoid withdrawing the funds shortly after you contribute to the account. So you want to leave your HSA contributions in the HSA account and use funds from your bank account, for example, to pay out-of-pocket medical expenses each year. And this will allow you to compound your HSA money at a tax-free growth rate. And so, in many respects, an HSA could almost be used as a medical expense account for your retirement, because you can compound your money over a very long period of time and then pull it out and get the optimal advantage from compounding by investing those assets and those monies. You also want to focus on taxable brokerage accounts because your risk of job loss is often lower than that of many other professionals. In many respects, you can take more investment risk, but the risk needs to be smart, calculated risk. And that usually means being broadly diversified. Based on your relative high tax brackets, investments should be tax sensitive. There's numerous tax strategies to help you save money at tax time. You want to keep turnover low and keep tax inefficient investments in retirement accounts, not in taxable accounts. I'm reminded of a client I looked at where there was a very high turnover, separately managed account strategy in a taxable account. And that equity strategy was resulting in significant increased taxes on an annual basis. You also want to avoid holding on to underperforming investments because you might have had them a long time and become emotionally attached. You can use tax loss harvesting in these instances if necessary. You should also always try to maximize charitable contribution deductions. And one way to do this is by selecting the highly appreciated assets when contributing to charitable causes. This can reduce your tax bill and increase your deduction. And there's plenty of other strategies here to discuss depending on specific situations. Studies have shown that short-term reactions to market news can cost investors around 30 to 40% of expected returns. So when you're done with a long, stressful day and maybe some challenging patience, I think the last thing that you might want to do is think about something else stressful, like the economy, stock market, including your personal finances. But it's important to be aware that there's many different types of investment strategies available, from aggressive to conservative. And the right selection should be customized to your specific circumstances and personal situation. And it's very important to find the right balance between safety and growth. Safety often comes at the price of reduced return potential and the erosion of value due to inflation, like we saw last year. And on the other hand, if you invest too heavily in growth investments, your risk can also be heightened. So when assessing investments in portfolios, you want to focus on a few key elements. Asset allocation and diversification involves the composition of fixed income and equity categories in your portfolio, and building a portfolio with those two categories that could perform in the long term under a wide range of circumstances. So typically, as equities and bonds and fixed income often has an inverse relationship. And that's one of the reasons why asset allocation is a very important topic. Tax efficiency is also important. Investment turnover in individual stocks or mutual funds can lead to short-term and long-term capital gains. In many respects, most people aren't aware of this, I find, but mutual funds can have very significant embedded gains. And in some instances, you could end up paying taxes for economic gains you never even realized based on the timing of your purchase and just the way mutual funds are structured. Risk reward profile is another important point to look at. This involves understanding the valuation and return potential. There's many good businesses to invest in, but if their stocks are priced too high from a valuation standpoint, they might not make for good investments. And that's really important. Then the last point, just cost effectiveness. This involves the various costs with investment strategies or investment categories. And these costs can vary quite significantly depending on the manager and the strategy. And that's something that's very important to look at. I always try to keep that to a minimum, as I think that's an important long-term key to invest in. So a financial plan can help you uncover areas of risk and opportunity. And it's important to conduct ongoing periodic reviews of your investments and rebalance your asset mix if necessary. So over the course of time, you might have like what happened in the 2010 to 2020 period, growth stocks significantly outperformed. And if you weren't rebalancing, growth stocks became a very large portion of your investments. And that could create problems, as we saw last year, as growth stocks were one of the hardest hit segments. So that's why it is important to periodically rebalance your asset mix. Here's 3 common investment portfolio problems and solutions that I've seen. So if your portfolio has become overly concentrated in growth stocks, for example, you want to change the asset allocation and add in value stocks. This will result in improved diversification and risk reward profile. Growth stocks and value stocks, it's important to note, they each behave differently in different types of environments. So in rising interest rate environments, growth stocks tend to underperform value stocks. And in interest rate environments that are declining, growth stocks tend to outperform. So it's important to have a mix of these categories of stocks. Here's another situation. If you have large capital gains taxes from investment turnover, there's definitely ways to reduce that. You want to use tax efficient vehicles to reduce your taxes. This can allow you to maintain market exposure while reducing taxes. Here's one last example. A client was that I was working with last year, 14 years until retirement, but their IRAs, when I first reviewed them, I noticed held about $300,000 in cash, and so they were missing out on an opportunity with respect to compounding their money over a very long period of time. And so, in this instance, we sold the cash related money market funds, and we invested in higher quality equities. And over the course of 14 years, assuming a 7% return, which I think is reasonable, they're going to generate approximately gains of $470,000 to use for their retirement. So it's important to remember to review your estate plan as changes occur in your life. These can include marriage or divorce, birth or adoption, death of a spouse, inheritance of assets, changes in beneficiaries, and many other changes as well. Lots more background on myself and Wharton Wealth Planning, including media articles, videos, and podcasts, can be found on our website. I hope you found this webinar helpful. We're always willing to work virtually to save you time. And now I'll take a quick look to see if there's any questions that have come in. I'm getting a question here about working with the CSP and how exactly that works, which is a very good question. So a certified financial planner, just to give a very quick background, is a certification. It takes about 650 hours of educational training and a 6-hour exam to get the certification. And the CFP certification is meant to bring all the different pieces of people's financial lives together. So the CFP certification looks at everything from investment planning to retirement planning, insurance, all the different types of insurance, ranging from life insurance to malpractice insurance, umbrella insurance, home insurance, as well as other things like education planning, trust and estate planning. One more question's popped up. How do you assess risk tolerance in clients? Is the only best way, what's the best way to go through a bear market? Okay, so risk tolerance is really, really important. I think one of the most important things that an advisor, responsibility that an advisor has, is to make sure that the risk tolerance and profile of the client is properly reflected in the investments. I could think of an instance where a 70-year-old woman that I had met with had a very aggressive portfolio and she wasn't working anymore. And when I saw the portfolio, I felt like it really didn't match her needs very well. So I think it's really important that a wide range of factors are looked at, both qualitative and quantitative. And this could range from how they sort of emotionally feel when they experience large short-term losses on paper in their portfolio, large declines in the market, as well as their financial ability to actually absorb those losses and still be able to meet all their obligations and you know their goals in the short term. And so all those things are really important. I provided a 20 question assessment, as well as look at the financial plan and all the different aspects of a person's age, their health, their family. If there's short-term education goals, that's going to be really important, because I would never want somebody to be taking excess market risk when in the short term, they have to fund their child's education. And I think that that's really important. So there's tons of different factors to look at there. And I do think it becomes most helpful in bear markets so that the stress and anxiety level isn't there. People sleep better. They can focus on what's most important to them. And their brain doesn't have to be listening to the news about, the market declining 5 or 6% in some instances in a week or even less. I think we've seen most recently with some of the regional banks, that was a really big situation in that it was unexpected and large declines occurred in a lot of regional banking stocks. And some actually literally had to fold up and go into government receivership or be acquired. And so the risk tolerance helps to put in light where a person's investments are, what their exposures are, as well as mitigate situations like that where they might have too much exposure and they shouldn't have exposures in certain areas. So that's done proactively, and I think that that's very important. So that's the last question. Definitely hope everybody found this Q&A and presentation helpful, and I hope everybody has a great rest of the evening.